In the book Stocks for the Long Run, Jeremy Siegel, PhD and professor of finance, shows his studies of how investments have behaved in the long run. He studied the return of different asset classes and discovered that the stock market is the best option for long-term investors. In this video, we will go over the top 5 lessons from the book Stocks for the Long Run by Jeremy Siegel. The first lesson is the best asset class for the long run. This chart is the most important chart for investors. It shows the stock market's total real returns compared with other asset classes from 1802 to 2012 after inflation. $1 invested in the stock market would have accumulated more than $700,000. The second best performing asset were bonds that returned almost $2,000, which is nothing compared with the $700,000 return from stocks. Even the stock crash of 1929, which caused a generation of investors to shun stocks, appears as a mere blip in the total stock return index. Bear markets, which so frightened investors, pale in the context of the upward thrust of stock returns. No other asset class, bonds, commodities, or the dollar, displays the stability of long-term real returns as do stocks. In the short run, however, stock returns are very volatile, driven by changes in earnings, interest rates, risk, uncertainty, as well as psychological factors, such as optimism and pessimism, as well as fear and greed. Yet, these short-term swings in the market, which so preoccupy investors and the financial press, are insignificant compared with the broad upward movement in stock returns. This shows that in the long run, the stock market is the best asset class. Of course, we do not have 200 years to wait for $1 to become $700,000, but we can hold our investment for 20 to 30 years and have a fantastic return. The second lesson is stocks are less risky than bonds. In finance and economics, there is a universal conception that bonds are safer investments than stocks. If you look at them from a volatility ratio perspective, stocks will fluctuate more than bonds with no promise to deliver returns. In this chart, we can see the highest and lowest real returns on stocks, bonds, and bills over different holding periods from 1802 to 2012. Stocks are unquestionably riskier than bonds or treasury bills over 1 and 2 years. However, we can see that the longer the holding period, the lower the risk stocks are. When we look at a 20-year holding period, stocks have never fallen below inflation, while returns for bonds and bills once fell as much as 3% per year below the inflation rate. And for a 20-year holding period, the highest yearly return for stocks was 12.6%, while bonds were 8.8%. In this table, we can see the percentage of times that stocks return outperform bond or bill returns over various holding periods. As the holding period increases, the probability that stocks will outperform fixed income assets increases dramatically. Over 30 years horizons, stocks outperform fixed income near 100% of the time. So, looking at the data, we can conclude that stocks are safer and offer better performance than bonds for the long-term investors. The third is to invest in ETFs. An index fund, or ETF, is a basket that holds many stocks designed to mimic the overall performance of any financial market or market sector. Investing in ETFs eliminates the risk of individual stocks. If you invest in the S&P 500, for example, you will own the 500 biggest companies listed in the US stock market. The big advantage of ETFs is that you don't need to spend hours studying a company to invest in and still have a fantastic return in the long run with less risk than picking stocks. ETFs are also a better option than choosing a managed equity fund, as the past performance of actively managed equity funds is not encouraging. The fees that most funds charge do not provide investors with superior returns and can be a significant drag on wealth accumulation. Most index funds have low fees. Furthermore, a good money manager is extremely difficult to identify, for luck plays a role in all successful investment outcomes. If you are a good stock picker like Warren Buffett, you can have a better return than investing in the S&P 500. However, being a good stock picker is not an easy task. Even Warren Buffett said, for most people, the best thing to do is to own the S&P 500 index fund. The fourth lesson is the importance to invest in global markets. Superior long-term returns of stocks were not unique to the United States. Investors in other countries realized returns that were near or even exceeded those in the United States. In this image, we can check the annual return from stocks, bonds, and bills in several countries between 1900 and 2012. In all of them, stocks were the best option. The reason for investing internationally is to diversify your portfolio and reduce risk. Foreign investing provides diversification in the same way that investing in different sectors of the domestic economy does. It would be a poor investment strategy to pin your hopes on just one stock or one sector of the economy. Similarly, it is not a good strategy to buy stocks only in your own country. Imagine your country faces an economic problem. If you are diversified in another country, you may have protection. With globalization, many companies have their profits coming from several countries. This also is a good thing that brings diversification. The fifth is to buy and hold stocks. We can conclude from this book that the best investment strategy is to buy and hold stocks. If you invest for the long run, at least 20 years, you will probably succeed. Investors like Warren Buffett use the buy and hold strategy. He holds his stock for the long term. As he said, our favorite holding period is forever. Buffett says if you don't feel comfortable owning a stock for 10 years, you shouldn't own it for 10 minutes. Unless a company has suffered a sea change in prospects, such as impossible labor problems or product obsolescence, a long holding period will keep an investor from acting too human. Being too fearful or too greedy can cause investors to sell stocks at the bottom or buy at the peak and destroy portfolio appreciation in the long run. Let's see an example. If you invest $1,000 monthly for 30 years with a 6.6% yearly return, which was the historical return of the stock market after inflation, you would end up with more than $1 million. Buying stocks or ETFs for the long run is a winning strategy that you can use to build your wealth over time. In the Little Book of Common Sense Investing, John Bogle shows us that the best options for investors is to invest in index funds for the long term. You can check out the top 5 lessons from this book by clicking on the card on the screen. If you want to receive more videos about investing, please subscribe and hit the like button. Bye!